Well, I think we should get started. Number one, this is Mike Deon at Davis Life and Annuity. I'm pleased to have Jaime Meuller with AIN talking about some asset-based long-term care strategies that actually work. We have a really compelling product, and I know, Jaime, I don't want to steal your thunder, but let me also just mention that if anybody's got any questions, we do have a Q&A section. Feel free to go ahead and ask those questions. We'll probably circle back at the end. Jaime, is that correct? And answer those questions?
Yes, absolutely.
Okay. And also, I would also like to throw my 800 number out there, which is 800-747-5612. Please call with any questions after the webinar. I'd be happy to talk to you about case design and all the things that go along with it. So with that, Jaime, I'm going to turn it over to you.
All right. Thanks, Mike. All right. Well, thank you, everybody, for popping on. Sorry for the minute or so delay as we navigated this system. But before I dig in, I'll just kind of give you a very quick idea of who I am and my background and how I came to really focus on this asset-based long-term care market. So started my career in this industry that we love so much of insurance almost 20 years ago. Did a couple of stints at some major insurance companies, including Security Benefits and Aviva, back when that was a thing. Started really focusing as an annuity marketer. In 2008, when we all know the market kind of tanked and we at Aviva basically stopped writing annuities, so we had to very quickly, teach our advisors how to start incorporating life insurance into their businesses so they could maintain an income stream. From there, I did 6 years at another insurance marketing organization here in Topeka, Kansas. So spent, the first kind of a year or two really focusing on growing those advisors' life insurance business, but kind of quickly found my niche and my passion in helping them grow planning for care in multiple ways, whether that was making sure they were educated and up to speed on the available riders on the permanent insurance products, but more specifically, growing this asset-based long-term care market. And I think my extreme passion for this, I think just like anything in life, passion stems from experience, a personal experience. My grandfather suffered from Alzheimer's and ended up in a memory care center for over 13 years. And, he just went from very healthy to very sick. It seemed like almost overnight. And I watched as, everything that he worked to build was gone to help pay for that care. I watched my parents spend out almost everything that they had to help take care of him. My parents are 66 and 65 and still working. And probably will, for as long as they need to, as that impact. So I think that's why, again, I'm just so passionate about this space. So, my day-to-day is working with folks like at Davis Life, just helping them, again, kind of fully understand this market, who's competitive, where and when, and then helping them then coach their advisors to incorporate this into their practice. So with that, going to cover a lot today. Okay, this is the longest of a 3-part series that we're going to host. So bear with me as we cover a little bit of background before we really dig in kind of to the meat of this presentation with our ideas. So I think the big moral of the story here is that the story isn't changing. And I'm referring to the need for care. Unless you've just ignored every single marketing piece regarding any sort of long-term care or chronic illness, you have seen this statistic, and it's that 70% number. What they're still saying is that 70% of people over the age of 65 are going to need some sort of long-term care services in their lifetime, and that could look very different for a lot of people. But that number is staying consistent, so that this need for care is not going away. You're also going to see a lot of statistics out there about these average lengths of stay. I have very strong opinions on planning around those averages, again, just based off of my own personal experience. But if you stick to those averages, you know, they say it's 2 to 3 years. Some statistics you will see say 4. But what is changing every year is that cost of care. It's going up and up and up every single year. In fact, last year was the largest year-over-year increase for long-term care services in the last probably 20 years. So it's significant. And right now it's at $97,450 a year. That's the national average for a private room nursing home. So if you were, again, to look at the averages, you could be looking at a total bill of almost $300,000. Okay, that might not be significant to some, but it's significant to most. That will have an impact on an overall financial strategy. $300,000 is a lot of money. But again, where our story is trending is Alzheimer's. When you have a few spare minutes today, just do a quick Google search. And the statistics that they have out there, this projection, I should say, of the amount of people that are going to be diagnosed with Alzheimer's in the next 20 years is terrifying. And that is where we're looking at catastrophic impacts to somebody's financial plan. Okay, we're talking about $1 million plus all in to cover that length of care that's needed. So those are those numbers that should have you concerned. You know, where is that money going to come from? I always say, you know, when mom and dad need care, mom and dad get care. No one is going to deny that to their loved ones. So again, you're spending down their assets. You're spending down your own assets. You know, you're either going to have to pull that from your guaranteed income, you're going to have to pull that from your legacy, or possibly both. But something's going to have to give if there's not a plan in place to cover those types of expenses. And the opportunity out there to start working in this market is significant. I don't have this statistic up here, but I saw it last week. Only 11% of people over the age of 70 have any kind of long-term care solution in place to prevent this sort of an impact from just destroying everything that they've worked to build. So there's a tremendous opportunity out here to put some plans in place. So the old solution. This is your traditional standalone long-term care insurance. I think we've all heard what's happening out there in that particular market. It's just plummeted, and for a lot of reasons. To give you an idea of what I mean by plummeting, in the year 2000, there was 750,000 traditional long-term care insurance policies sold. 2015, 105,000 policies were sold. That is a dramatic reduction in people that are, interested at all in purchasing this sort of protection. And again, we all know the reasons, right? There's just a huge, resistance right now, not only on the point of, part of your clients, but on the, to the advisors that I work with too. You start talking about long-term care and you can almost see them through the phone, put the earmuffs on. They don't want to hear about it, okay, because they're thinking about the non-guaranteed premiums that are going up and up and up every year, sometimes 50, 80% at a time. They're seeing that companies that even offer these products just quit on it, right? They're out, they can't support it anymore. So, is their carrier going to be around another time? The whole use it or lose it, people are just over it. I think that was a risk they were willing to take when the premiums were consistent, but now that they're not, again, they're just not interested in this. So we're seeing this even further reduction of people wanting to pursue that sort of product line. But what that has done on the flip side, on the positive side, is it has given just a tremendous increase of activity in this asset-based long-term care solution. And the more and more we talk about this and educate not only our advisors in this industry, but then for them to educate their clients on these alternatives, I believe we're going to make more significant strides to close that gap between the risk that's out there and getting protection in place. So what asset-based long-term care is doing is it's that middle ground between, putting that LTC rider on your UL or IUL policy, or other end of the spectrum, that traditional long-term care space. It's just meeting in the middle. It's providing the solution while answering, excuse me, all of the objections to traditional long-term care. So it's a really unique space to work in. So you've got your death benefit, right? You're purchasing an asset. That's that whole asset-based. That death benefit is giving them that leverage on the dollar. Okay, so they're not, quote unquote, losing an asset or spending an asset. They're just repositioning an asset into a new asset for another purpose. And we're going to talk about, some of those ideas towards the end. All of the products out there in this asset-based long-term care market are going to offer some sort of return of premium. Now, it varies across the board, okay, depending on the product and levers that we can pull, but they're all going to be able to have some sort of return of premium should they change their mind. Cash value, okay, there is one carrier in particular, that would be One America, that offers a really strong cash value. So that asset is actually growing for them in addition to providing all of the benefits. But most importantly, I think it's that, the guarantee on the premiums, okay? Even though they might be a little higher than a traditional long-term care insurance policy, at least now, before future rate increases, they're locked in, they're guaranteed, they can never go up. But they're also, purchasing an asset with those premiums. So, the cost is justified with that premium. So this is my home. This is where I've chosen to really grow this industry. So I'm going to cover just a few little tidbits that tend to come up day in, day out when I'm working to educate not only my firms I work with, but also advisors directly. And the first one that comes up is, well, what is the difference between just putting my long-term care rider on my John Hancock protection UL? Why would I do that versus an asset-based long-term care or vice versa? Now, it seems maybe a little trivial, but it is extremely important, and I'll tell you why. But it seems obvious, right? What do they need? So when I'm guiding people through this planning process, I always say, first and foremost, they need to have death benefit in place somewhere else. Okay, we don't want to look at these asset-based products purely for death benefit, because we're just not going to get the leverage for the premium dollar that we can get in a traditional insurance product. So make sure that death benefit is in place. The fact that we have this death benefit on the asset-based products, right, that's more of that's a benefit, that's a perk. Okay, so what's the primary need for the sale? Again, if they need death benefit protection, you're going somewhere else. The fact that you can add that long-term care rider onto those products, that's your ancillary benefit. Okay, so we just got to make sure that we are positioning that premium where it needs to go. So if it's care that is the first and foremost need, that's when we're looking over at the asset-based products. And then underwriting, okay, can be very different. This bullet, if you will, is getting a little bit more nuanced as the years go on. Meaning that traditionally on a permanent insurance product, you're looking at a full underwriting process. I know most carriers out there now have some sort of quicker process based on age and face amount. But generally speaking, if you're looking at a traditional insurance product, you're going through full underwriting, which, as we all know, can take quite a long time, depending on how many records and all of that have to be pulled. But on this asset-based long-term care market, most of the time, again, there's always exceptions to every rule, you're doing an expedited process, okay, phone interview only, you're talking 2 weeks max, start to finish, okay? And they're issued kind of an all in like one class. So anybody that would be considered super preferred up to table 4, They're all issued together in this expedited process. So I'm going to just give you an example of, though, of this product to the need and why that's so expensive. Or it's so important. I was working with an advisor earlier this last summer who was very upset that the death benefit that he had applied for, and it was with John Hancock, nothing against them, it was just a $500,000 death benefit, but they said no. It would have had her overinsured. You wouldn't think that $500,000 would do that, but it did. So what we figured out what he had been doing as an ongoing strategy is backing into the death benefit with that product using the long-term care rider to get the benefits that this person wanted. Well, you know, again, kind of learned in a very harsh way that, quite frankly, John Hancock does not care that that's what you're trying to do. They write death benefit first and foremost. So what we showed him was an asset-based long-term care solution, getting her that same long-term care benefit, much lesser death benefit, but again, that wasn't the play here, for a lesser premium. It made sense to the client. He took the app, he made the sale, and now he's making sure that he's, again, positioning the products where they actually need to go based on their primary need. So wanted to cover that for you since, again, it always comes up. Long-term care versus chronic illness. This honestly could be an hour-long discussion if you wanted to dig into every single little nuance. We're just going to cover the high points. So when I say nuances remain, what I mean by that is this world of chronic illness riders is constantly evolving. Okay, so everything I say here, I know that there are a handful of carriers that are making exceptions to that. But so we're talking in very general terms, but it's important to understand some key differences between what these will cover when you're really looking to put together some planning for care. And the biggest one is what we call permanency. And this is referring to the condition itself that the client, has happening to them, and whether or not we can actually get benefits out of these riders on these permanent insurance products. So most chronic illness riders are only going to pick up the tab if that condition is deemed permanent, unrecoverable. They will have this condition for the rest of their life. Then your chronic illness rider can start kicking in some benefits. What it's not going to cover is temporary conditions. The most common that I see out there would be a minor stroke. Okay, so for a period of time, your client can't perform 2 out of the 6 activities of daily living, but they can recover eventually. Their chronic illness rider is not going to kick in any benefits for them. If you had a long-term care policy, like an asset-based solution, or even a true long-term care rider on your insurance product, it's going to kick in some benefits for them. So it's very, very important that you read the language when you're looking at a policy with an actual chronic illness rider, because there are options out there now. Just make sure maybe if that's important to them that you're looking at the right solution. Mortality discounting. This again applies to only the chronic illness space. And again, there's a few exceptions to the rule, but what this is saying is, I'm just going to use an example. North American's policies have those embedded chronic illness riders, and the language is going to read to them when they issue their policy that they can receive up to 24% per year for 4 years, should they have a permanent condition. That does not mean they're going to get 24% per year. And I've seen and heard that sold that way, which is a little terrifying. What's actually going to happen on these riders is that when it comes time for claim, the company is going to run what they call mortality discounting. And it's this big actuarial formula, and it's probably a little different for every carrier. And they're taking into considerations, are they male or female? What's their attained age? What's their life expectancy, and multiple other factors. And then at that point, they will tell the client, here's what you can have in this policy year. So again, it's not necessarily a bad thing. It's just important to understand. you know that there will be some benefits available. You just don't have really any idea what those are going to be. Where with a true long-term care rider or policy, you know exactly what your benefits will be and exactly how long they will last the day the policy is issued. Again, not saying one's better than the other, they're just different. Important to understand. Per diem limits, again, only applies to chronic illness riders. This really only comes into play when you're looking to take some pretty massive benefits out of your policy, but some policies are big enough where this could come into play. Anything up to the current per diem limit, and I think what we're like around 10,300 a month, I don't have that written down in front of me, is going to be received to the client tax-free. If they take anything above that, which they could very well be able to do, that portion will be considered taxable income. Long-term care riders, if it's considered a qualified expense, it's received tax-free regardless of per diem limits. And I will say here again, if mom and dad need care, mom and dad are getting care, and if there has to be some taxes paid, so be it. Again, just so important to understand what your clients have so that there's no surprises come tax time, okay? I want to cover one more thing, and then I'm going to dig into the market of asset-based long-term care specifically, but this one actually applies directly to the asset-based long-term care market. And that's indemnity versus reimbursement. And I'm sure everybody on this phone knows the difference. What I'm always still, after all these years, you'd think I wouldn't be anymore, sometimes a little bit taken aback by how passionate people are about this. And they will, argue like tooth and nail, which one is quote unquote better. I do not believe that one is better than the other. Everything that I kind of focus in on is just know what you're getting. There's pros and cons to both. But obviously indemnity, right? You spend your money however you want. Okay, so you still have to have a doctor say that you can't perform 2 out of the 6 activities of daily living. You've satisfied that requirement. The insurance company is going to accelerate to you whatever the policy says you can receive. There are a couple different types of indemnity, which I won't dig too much into. Just know that some indemnity contracts will actually make you prove that there is a plan of care in place and that the client has incurred $1 of expenses. Those boxes have also been checked. If you can get $15,000 a month, they're going to give you your $15,000 a month regardless of actual expenses. Reimbursement, obviously just the opposite. You're actually getting reimbursed for your incurred expenses up to your maximum amount. And that's generally going to refer only to your long-term care. I can't think of a single, indemnity or chronic illness type policy that's going to have a reimbursement. Again, pros and cons to both. This is where be nice to have that crystal ball and kind of see what their future care situation is going to look like, but that does not exist. So, the indemnity contracts where those can be of extreme value is if somebody spends all or most of their time needing benefits in their home. And what I mean by that is, you have that liberty to truly spend that money however you want, and maybe it wouldn't be on things that would be considered reimbursable. Best example I can think of is, when my mom was helping to take care of my grandpa, she had to miss a lot of work, okay, and she wasn't compensated for some of that work. Had my grandfather had any sort of a policy with an indemnity rider, a portion of that money could have been used to help supplement that lost income that she had had. Cannot do that with a reimbursement contract. So that's just kind of one example of how that can be a benefit. The downside to indemnity, and I have seen this happen as well, is you've got to make sure that there is a caretaker if the actual insured is not able to do so, that's managing that money properly. You got to make sure that that caretaker isn't going to take some of that money, if not all of that money, and go to the casinos. And I use that because that actually happened. So again, just if you have an indemnity contract, just make sure, okay, that there's somebody there that can help manage that money. Other downside possible to indemnity is there is the risk of just depleting that death benefit much faster than needed to happen. Because it's really hard to turn down, say, $15,000, right? When maybe you only needed $6,000. So, and just keep all that in mind is all I ask. Reimbursement, though, I will say one more thing before we move on. If you're not familiar, reimbursement contracts are not what they used to be years ago. Okay, you no longer have to, picture your clients buried in bills and paperwork and managing this whole process. Every company that I work with that offers, a reimbursement contract has a program in place to help with that, and it costs nothing. Okay, they will work directly with the providers, let's say a nursing home. They're working directly with a nursing home, receiving those bills and paying those bills. They even take it a step further. I can say One America specifically, where they kind of act as a little bit of a watchdog service too. Okay, they're going to monitor those bills and just make sure there's nothing in there that doesn't look right, right? Because a nursing home would never, ever, ever like overcharge somebody, right? Or of course it happens every once in a while. But they're going to look at those things and they're going to talk to the insureds and say, we're questioning this particular issue. So a little bit of a watchdog, if you will. Again, they're looking out for the best interest of their insureds. So indemnity versus reimbursement, again, moral of the story, I do not believe one is better than the other. Just, again, super important to understand what you're putting in front of your client so that there are no surprises come claim time. Okay, so this asset-based long-term care market, I work with many carriers in this platform, but I have 5 that I believe are, kind of my key players. And I pivot to each of them depending on every single unique situation, which is such a great option to have. So I can always make sure that you are ultimately getting what I feel is the absolute best solution for your client based on their needs. So I'm going to kind of lump these first 2 together. So there's Lincoln MoneyGuard, obviously one of the more well-known, been in the market a long, long time. But I kind of loop them together with Pacific Life and their Premier Care product. Now, the Premier Care products can be a little bit hard to get a contract on. They love their career channel, not so much the brokerage where we all live and play, but they are both very, very solid contracts from a pricing standpoint. Okay, if you've only got one insured that you need to cover, just one, okay, and a 4 or a 6-year benefit period is very comfortable for them. Those 2 are going to price out right on top almost every single time. So very strong in those exact situations. I'm also going to lump these 2 together kind of in my same bucket. So that's Nationwide. They have a product called Your Life Care Matters, and Minnesota Life rolled out their player, their product in this market in, I want to say it was January of 2017, and it's called Secure Care. Now, these 2 products most of the time are not going to price as well as a MoneyGuard or Premier Care. And the reason being is they offer indemnity benefits. And most of the time you're going to see a little bit of a pricing crunch on that. Just they have to price them that way, right? Because there's the opportunity that they're going to pay out way more than necessarily would need to be done with those indemnity benefits. But if that's kind of where that conversation is going with your client and that is super appealing to them, again, strong solutions with those 2 products. I will reiterate the same thing as the first 2 though, one life only, okay? One insured to cover, and they're still going to be strong at that 4 or 6-year benefit period. It's just the way they design their products, that's where our sweet spots are going to be. There it goes. Okay. But One America, and we are going to focus our time on this one. The reason being, they are absolutely dominating my conversations for at least the last 3 years, and even more so, definitely the last 2 years. And it has nothing to do necessarily with pricing and spreadsheeting, and everything to do with the fact that they offer value, pure value that nobody else on this screen or even other carriers not on this screen can do. Okay, and I'm not going to bullet this out for you, so let me just kind of run through them really quick. First and foremost is their ability to do a second to die death benefit structure. Okay, they're the only ones that can do that. What that's doing is it is leveraging a tremendous amount of their premium for the pure long-term care portion of the policy. So regardless of which product that you look at, general rule of thumb to think about is about 75% of the premium is funding the death benefit. About 25% is funding what I call the pure long-term care portion. That's where we're extending long-term care benefits past when our death benefit would have been depleted. Okay, that's kind of the best way I can describe it. So by only having to pay out one death benefit, again, you're able to leverage a tremendous amount of their premium towards long-term care for both insureds. It is truly an unbeatable solution for long-term care. I can get both insureds on a joint One America more long-term care per month, or up to both lifetimes, than I can with any two combined standalone policies. So it's super, super powerful. And I'm going to show you an example of that. I actually said the second one, lifetime benefits. Nobody else is offering those in this market. So where this is really attractive is, again, on these joint life policies, because it's almost a why not. If I can get them more per month than in two money guards, why wouldn't we go lifetime? But it's also very powerful on single life cases. So if I ever have a situation, again, where there's just one life to cover, my rule of thumb that I would coach people on is show them, say, a 6-year money guard, but then show them a lifetime One America. They might get, well, they will. They're going to get, less per month of benefit out of that contract, obviously, but you would be surprised how many clients will find the value in that. And for most of the advisors that I work with, it's been, once they've started implementing that, it's kind of a seamless transaction. Because most of these clients have already been ingrained with this idea of lifetime, okay? They've got annuities that are going to pay a lifetime income. They're not taking their life, they're not planning income for a life expectancy that's going to pay them until they die, forever, right? Because they're going to live forever. They've probably got some sort of a GUL in place. They like the idea of having that death benefit to age 120, even though we know they're not going to live that long. So without even having to try, you'd be surprised, again, how many clients will appreciate that. And again, that might be the time that they tell you about their Aunt Sally who, needed care for 10 years. So lifetime benefits. One America is also the only company that is going to offer premiums to be paid all the way to age 100. That's huge. That actually was probably the most popular design that I saw last year. And so, what that's doing is it's opening up these asset-based solutions to a tremendous amount of clients from a pure budget standpoint. Maybe they just don't have a large lump sum to reposition comfortably, or maybe they just don't want to. They really like where that asset's at. And I'm going to show you an example of this one, but they can take a distribution out of that over time and use those as their premiums ongoing. So it just, again, it's just opening up some planning opportunities that do not exist with these other carriers. I'm going to touch on two more things, and I promise we're going to move on. Issue ages, okay? You'll see on there that it says annuity care. So they do offer an annuity based line of products. Two of those products issue up to age 85. So we can't get any sort of long-term care solutions in place at that age pretty much anywhere else. Okay, so it's an opportunity for your older clients that have aged out of just about every other solution on the table. So huge opportunity for those clients. And then finally, their underwriting at OneAmerica is different than the rest of the carriers. So yes, they do offer that express underwriting platform. Okay, and that's the goal, right? They always want to go that route. And that's where, again, you're phone interview only and you're issued in, that top class up to table 4. But where every other company is going to shut the door if they don't think you're there, OneAmerica will offer to do a full underwriting process. And they're going to pull that APS. There might be an exam. I would just almost count on it, right? And be pleasantly surprised if you're not, because I see it required more often than not. And they'll take that extra look. And one of two things are going to happen. Okay, they're either going to get that little bit of extra information that they needed to go ahead and put them in that top class by being able to take that time to work that process. Or, and this is huge, they will issue policies up through table 8. And in just about any other market I've ever worked in, ratings are not a great thing. Is it going to cost more here? Of course. I'm no longer surprised, actually, how many clients take those policies. Because these are your clients that are not getting anything else, nothing. Okay, they're not getting the money guard. They're probably not going to get their long-term care on a standalone policy. They're not getting that long-term care rider on your John Hancock UL. Okay, and quite frankly, these are probably going to be the clients that need it the most. So I see those placed all the time, especially when we're working with single premium, move asset to asset type strategies. I actually have advisors that will come to me once a month, once a week, whatever their preference is, with all of their declines. So this is an idea for you guys. What have you been declined on? What have your clients been declined on with your MoneyGuard or your Premier Care, your Nationwide, your riders, okay, on your permanent insurance products, your traditional long-term care? Get those over to Davis Life. Let us take a look at those. Maybe 50% of those, we can actually get an offer on the table. And then you have the ability to come back to your clients and offer a solution. That's an amazing position for you to be able to be in. Okay, all right. Now we're moving on to the actual sales ideas. I told you we'd get there. And just, this will be the longest of the 3 webinars that we do. Okay, now that we've moved past all this, our next one, I promise we're going to just dig straight in. So thank you for bearing with me on all of that. So what I'm going to show you is what I call this power of that joint life design. And this is with OneAmerica again, because it has to be. So let's say we have a husband and wife. Okay, he's 65, she's 63. And they've got $100,000 of some cash. Okay, this is with non-qualified money. Maybe it's in a CD, maybe it's pure cash, maybe it's sitting in a mutual fund, wherever, so long as it's non-qualified single premium. Here's what we can do with that. So the way that I would design this particular solution, I always try to minimize that death benefit as much as I can so I can get the most long-term care out of this. So that $100,000 turns into a tax-free death benefit, second to die death benefit of just under $128,000. So again, not a ton of leverage, right? Can you get more death benefit somewhere else? Yep, you sure can, but it's still leverage, okay? Should they die and never need the care. If they do need the care, they are each, okay, both of them able to get $3,840 a month tax-free for both of their lifetimes, indefinitely, as long as they need it. Okay, so if they were both maxing out that care, if that was a situation, they could get over $92,000 a year tax-free for both of their lifetimes. Okay, now that might not seem like a lot of care. So let me show you, again, how would this compare if we did 2 separate policies? So here's what you're looking at here. This top line, okay, that's our OneAmerica Asset Care 1. Okay, that's their single premium cash policy. So again, you've got your $100,000 in, your death benefit. I'm combining here, okay, for both insureds on this. So up to $76.80 a month for lifetime. What I did for the other companies here, so that's MoneyGuard, Minnesota Life Secure Care, that's Nationwide, Your Life Care Matters, and Pac Life Premier Care, is I took that $100,000 and I split it up. I did $50,000 on my husband and $50,000 on my wife. And again, I'm combining these benefits. So it's the total of the two. So the next best that we can get from a long-term care standpoint, because that's our focus, is with the two MoneyGuards. Combined between the two of them, they can get $6,170 a month for 6 years. And it's just, the values are just going to go down from there. So this is the question. Again, would you rather have $6,170 for 6 years or $7,680 forever? This is why I said it's almost a why not. I don't know how you could really sell against that, okay? If care is your first and foremost consideration. Now, to be fair, no carrier wins in every single aspect, right? It's impossible. So yeah, One America is going to lose on the overall death benefit, right? There's one death benefit of $128,000. Our combined death benefit with MoneyGuard is the highest. Where One America will lose every single time is with their return of premium. It's not their strong suit, okay? So of their $100,000, they're looking at $72,421 in year 10. I can get 100% with MoneyGuard, but I'm gonna have to dial down those LTC benefits. Again, we can get 100% return of premium elsewhere. But I will tell you, over the past 5 years, I've seen this trend, and it's really kind of honed in, probably just the past 2 years. Return of premium is becoming less and less and less a part of the conversation, not only on behalf of the advisors, but on behalf of the insurance companies. You saw MoneyGuard pull that back and give an option now from 100% or 80%. Pac Life, same thing. Because what's happening is, the persistency level on these policies is sky high. They're not surrendering these once they're in place. They're either going to die and pass the death benefit, or they're going to use their benefits. So it's, where the industry is starting to do is just retool these products to leverage more of their dollar for return of premium. So I hope this is really painting that picture for you to start looking here. And before I move on to my last idea, I will say this joint life design with One America does not have to be a husband and a wife. There are tremendous opportunities out there. The requirements are an insurable interest, no more than 25 years apart in age. I see a lot of business owner cases. I see parent-child, if the math works, which that is actually a tremendous opportunity for widows and widowers if they have an adult child within that age range. Maybe that can be a follow-up conversation, but that is powerful because they work a joint equal age type situation. I see siblings, just life partners, so long as they've been in a committed relationship for over 12 months, then they're in, and same-sex couples, same thing. So again, tremendous opportunity there to take advantage of that. So if you got two people, make sure you're taking a look at the One America solution. Okay, last idea. Sorry, I'm pushing a little long on time. Sorry about that, Mike. So again, probably the easiest way to start digging into this market, again, you got to find those assets that are prime for a reposition, whether it's all at once or slowly over time. I'm going to show you the slowly over time this time. I'm going to show you all at once using annuities next time. But this strategy is so effective, okay? It's using an annuity. Now, tons of annuities are sold every single year, okay? Just in 2016, $2.8 trillion of annuities were sold. That is a mix of all different types, variable, fixed, index, qualified, non-qualified, but look at the history here, okay? Except in 2008, when I was an annuity marker, that was not a fun year. But what this picture is telling you is consistently over time, there are trillions and trillions of dollars of annuities sold. Here's another big number, 73%. Okay, this was a 2015 Gallup poll. They asked annuity owners, what are you going to do with this annuity that you own? 73% did not say, I'm going to use this for income, which was my original intention when I purchased it. Needs change all the time. Now that annuity is hanging out, okay, it's either going to be passed to their kids or that's that asset, right? That's on their short list to use should they have a catastrophic illness or need nursing home care. This 73% is literally telling you exactly what you need to do with this annuity. So just using the 2016 number of 2.8 trillion, if this particular average stays true over time, eventually 2.1 trillion of those will be prime for a reposition into an asset-based long-term care solution. Okay, and again, just think back of how many trillions are out there. You don't even have to be an annuity writer for this to be effective for you. Just because you don't focus on writing annuities possibly, that's totally fine. You don't have to. Your clients probably have some in their assets that somebody else put in place for them. So you still have these opportunities. So I'm going to show you for our same couple, okay, our 65 husband and our 63 wife. Let's say they had a $250,000 annuity, and let's say they had a 10% free withdrawal. That's very, very common. This is the strategy I see put in place all the time. We're just going to take 5% of that distribution, okay? And a lot of people will do this to fund, death benefit as well. We're using that same concept to fund for care. So let's say 5%, assuming some taxes, okay, and our net distribution that we can use as premium is $93.80. So what that's going to get them is, again, a day one, tax-free, $162,000 death benefit. So we're pulling from a taxable asset and we're getting $162,000 of tax-free death benefit. Again, should they never need the care. Meanwhile, they still have a very large chunk of their annuity in place, at least that first year, right? But from a long-term care perspective, now we're talking about $6,500 a month of long-term care per person for both lifetimes. Or again, if they're both pulling that $13,000, we're talking $156,000 a year, tax-free, forever. That's incredible leverage. Now, this one's a little bit harder to compare because, again, we don't have any other options for a life pay solution in the asset-based market. So I'm having to compare two traditional insurance products. And we all know that an actual second to die life insurance policy with long-term care riders, most of them are not going to pay benefits except only for the surviving spouse. Nationwide is an exception to that rule. They do offer a second to die where both spouses can access the long-term care pool while they're both living. So let's say we use that $93.80 as premium. Again, higher death benefit because we've already covered that. Each of them, and this is combined, $4,192 a month for 50 months, or $13,000. Okay, let's say we split up that $93.80 and we, excuse me, put them in two individual. This is also with Nationwide on their no-lapse product. Again, stronger combined death benefit between the two, little bit better on the long-term care. Now we're talking $66.75. That's combined, again, for 50 months. And then, finally, probably the other most popular solution that I see is doing two John Hancock Protection UL. Again, let's split that premium up, total combined death benefit, the highest, right, because it's a current exception product, our highest long-term care there, but again, for 50 months. We can get that higher, but it's going to last shorter. So again, moral of the story here, if you are leveraging for long-term care, this joint life, One America, is so dominant and so popular. And then look at that cash value. By year 10, again, that One America has that guaranteed 4% cash value growth because it is a whole life policy, $44,000 compared to the competition. So again, just two ways to take advantage of this. A single premium reposition or slowly reposition an asset over time. Either option, very powerful using this joint life design. Probably two of the easiest ways to dig in, okay? And that's it, Mike. I know that was a lot, so thank you all for bearing with me on all of that. So do you want to see if we have any questions, Mike?
I don't see any questions at this point, but feel free. There's a Q&A button on the bottom of the screen. All you need to do is hit that, ask away, and we'll stay on the line for another minute or two and just see if anything pops up. You must have explained everything perfectly, Jaime.
Well, I usually get a few. Go ahead.
Just a few other thoughts. And, one of the strengths we have here at Davis Life, we're talking about underwriting, and, that's obviously a huge part of this thing, whether we're just underwriting for the mortality and or the morbidity, which is the long-term care piece. We have tremendous resources here at Davis Life from an underwriting standpoint. Our in-house underwriter, his name is Bob Pedigo. He's only been doing it for 37 years. He's been a chief underwriter. We do an awful lot of impaired risk. So don't necessarily count out your customers because you don't think they can qualify for long-term care. Let's have the underwriters take a look at it, and let's see if there's some other options. With One America, especially in the second to die chassis, we've had some tremendous underwriting as a result of that. So I do have a question here. Kent asked, on the first illustration, is there an ongoing premium involved in addition to the lump sum contribution?
No, nope, that is completely paid up.
And
one and
fully
done.
Guaranteed, I might add.
Yes.
Yes, because
yes.
It is a whole life contract. Great question, Ken. Let's see. Joe asked a question. Oh, he said, great job as always. Thank you, Joe. Appreciate that. Hopefully you guys got some good intel here. My number is on the screen there. Feel free to call anytime. We'll talk about case design. We can talk about underwriting issues, and more importantly, get you the tools that you need to make those sales, because this is on everybody's mind. Long-term care is a huge issue. And I just really want to thank you again, Jaime. Great presentation. Look forward to the next one.
Yeah, absolutely. Me too. Thank you, everybody.
Thanks. Take care.